So as we're seeing right now, we're coming off of a January that was very volatile. In fact, both stocks and bonds, for the first time in a long time, were down together in the same month. Bonds were down because interest rates were rising, and they continue to rise as we start the February off. In fact, the 10-year Treasury right now is about a 190, 192 as we film this. Now, it's not just the U.S. that are having rising interest rates. We also have global rising interest rates. In fact, a positive sign is that the German Bund, their 10-year equivalent, if you will, and their sovereign debt is positive for the first time in years. They've always had a negative interest rate, if you can think about that. And now it's a 0.27 basis points. So 27 basis points on their 10-year, which is positive. That means that the economy is growing. It also means that there's inflation and that the yields have to stay ahead of the inflation. And everywhere around the globe, we see increasing expansion in global yields. Now, that being said, that's also sending a message to the Federal Reserve. We've talked about this many, many times, that they could be behind the curve. And we'll find out how they choose to deal with this in their March meeting, which is less than a month away right now. And they're going to raise interest rates. Now, the question is 25 or 50 basis points. We're not going to stand here and debate that at this moment in time. What we do know is inflation and rising yields impact the U.S. economy. And one of the things we're paying attention to, as you should be too, as we're thinking about positioning our clients' portfolios, is the ultimate impact to consumer, because the wallet share now shifts. It goes from this last year, what the Federal Reserve was talking about, which is food, is transient in terms of the inflationary pressures, right? We saw some really increasing price. Right now, we're feeling the impact at the grocery store, at the pump. I mean, we're $1 more than we were last year just for gas, if you will. It's just hard to imagine. So inflation is essentially not transitory. It's going to be very sticky, we believe. Also, we'll see it in wage inflation data. In fact, this Thursday morning, I'm going to be featured on Fox Business with Maria Bartiromo at 3:30 in the morning Pacific time. If you're up, you're more than welcome to join us. We'll have a replay for you. But it's ahead of the CPI number. And the CPI number is all eyes this week are on that, is basically the inflation read. If it comes in hot, we're going to see, or higher than an expectation right now, we're going to see markets sell off. If it comes in lower or less than what was anticipated, we could see a huge rally, because that means that the Federal Reserve essentially could be at the right spot at the right time. So is the Fed behind the curve, or are they playing catch up? That's on Thursday morning. It's going to be a big movement in the market. In the meantime, what does this mean, Rob? Well, basically it's the wallet shift for the consumer. They're going from spending their money on food, which could be temporary in terms of inflationary costs could come down because of supply chain, a few others, to housing. Housing is the most impactful. Right now, we just saw mortgage interest rates, right? The global yields also impact real estate markets by way of interest rates on mortgage pricing. Mortgage pricing, the Federal Reserve's backed away from helping and assisting that market, keeping mortgage interest rates lower. Mortgage rates, yields have spiked. They went from the mid 2s to the just mid 3s, only under the 4s right now, depending upon that. What does that mean? Well, in most cases for housing, whether you're going to purchase a home, you want to refinance, or even if you want to ultimately be in the rental market, the inflationary pressures are hitting those yields. And essentially it could be 25 to 30% impact or higher prices than we were even 3 or 4 months ago, to believe it or not. So this is a huge negative blow to the U.S. consumer, because this is important to see. We'll see if it moderates later this year. Sometimes you always get the stretch effect where the markets stretch out and then they moderate a little bit. So hopefully we'll see that get some easing pressures. And one way we're going to monitor this right now is the housing market, right? Will inventories increase because housing affordability is decreasing because this payment is going up? So we will pay attention. Right now in the U.S., in some markets, it's less than 2 to 2.5 months worth of supply. So supply and demand equilibrium is not there, pushing prices up. Now, what could cool off that and add more inventory is bringing the affordability down. And that's by way of the interest rates. Not all people in the market are buying cash, or buying with cash, if you will, or all cash buyers, which then they don't need a mortgage. But at this moment in time, we believe this scenario, the rise in global interest rates and the shift in the client wallet share from housing to from food to housing, will decrease the housing affordability, whether you rent or own, and increase inventory. It's going to take some time to work its way into the system, but that's what we could see play out in 2022. Now, we're going to be positioning accordingly. Again, with every give, there's a get, and so we're positioning our clients' portfolios to take advantage of this scenario, but also at the same time be very aware of what markets are paying attention to. So that's our update for today. Thanks for watching, and we'll see you again later this week.